Investing during a recession may seem counterintuitive, but for investors and professionals like Warren Buffett and Charlie Munger, there's no better opportunity to invest during a catastrophe such as this one. Investing during a recession is not as frightening as you would assume. In reality, it's considerably more doable for those who have the money, have done their homework, are patient, and pay attention. However, having an investing plan during a recession is critical to guide you as you make investment decisions. So let's learn some tips on how to invest during a recession. Step 1. Get into cash. To invest, you must first have the cash to invest. This is why it is strongly advised to keep cash handy during a recession, or ideally, well before recession, so you can invest it when the occasion comes. It's now more vital than ever before to save and spend money sensibly. The more you save and spend less on non-essential or luxury products, the more money you will have to invest. Recessions and unemployment are inextricably linked. During a recession, the unemployment rate is expected to climb. This is another incentive to keep cash on hand and spend wisely. You will have more money to invest if you can live on less. Step 2. Look for companies that are recession-proof. After you've saved some money, you may start thinking about where you want to put it. When looking for equities to buy during a recession, look for recession-proof companies. During or after a recession, the best companies to purchase are those that fulfill the 4 M's of investing, meaning the company has meaning for you and you recognize the value it provides. Moat. The company has an insurmountable edge over the competition that prevents them from competing on pricing. Management. The company is headed by persons with competence and integrity that are capable of leading the company through a recession. Margin of safety. You may purchase the company for an at-sale price that virtually ensures a 15% yearly return for the following 10 years. It's always crucial to acquire stocks that adhere to these principles, but especially while looking for the best stocks to buy during a recession. Companies that thrive during a recession will fulfill all of these requirements. Add a company to your watch list if it meets these 4 criteria. This is the list you'll consult when you're ready to invest and the pricing is appropriate. Step 2. Research. It is always vital to investigate any firm in which you intend to invest, but it is more critical during a recession. So what changes during a recession? The way a corporation responds to a downturn predicts its future success. Here are a few points to consider. Any company news to see how it aims to be profitable throughout the recession. The impact of the recession on the company's industry as a whole. The things you're passionate about. Spending money on them. Understanding the firm you want to acquire, how it is affected by the recession, and how it is responding is critical for prudent investing during a downturn. How would a long-term economic slowdown influence business and industry? We anticipate seeing higher losses as firms continue to feel the consequences of closures, a considerable fall in housing spending, and resource reallocation. Profit losses have an impact on us as investors and how we decide which companies we want to hold long-term or not. This data assists us in determining which firms will survive any future economic downturns and which will not. Step 4. Invest in your education, especially important during a recession. Don't be concerned if you're feeling out of your depth. Put your foot down and educate yourself on how to invest money so that you may prosper in any market circumstance. You're already doing well if you're watching this video. Continue to prepare by following the actions of skilled investors, studying firms in your area of expertise, and attending investment trainings. You can also watch this Charlie Munger video for more tips on investing during a recession. Step 5. Prepare your watch list of companies. You may establish your watch list once you have educated yourself and conducted significant study to identify the firms that are successful even during a recession. This is the fun part. To do that, we recommend that you watch our video on Is It True That There Are Businesses That Rarely Screw Up? It will help identify business ideas that survive difficult economic conditions. Step 6. Be patient. It's reasonable that you'll be anxious to invest as soon as you've completed your watch list. However, patience is a virtue, and it is one of the finest traits to have while investing during a recession. You've got the money, you've done your homework, and you've got a company watch list, and now you're waiting for the perfect margin of safety pricing. When investing during a recession, start with 25% of your intended investment and see what occurs. There's nothing wrong with testing the waters to verify you're making the proper decision. It's time to buy when the stock of a company on your watch list reaches your buy price. Step 7. Keep an eye on what experts are doing. Experienced people's behavior can assist in indicating when to purchase, when to sell, and what to watch for. Because these individuals have been doing something for a long time, you may learn a lot from the decisions they have made and are making now. Pay attention to investment experts you respect and see how they buy or do not buy stocks during a recession. Warning signs to notice in a business during a recession. We've discussed what to look for. while looking for recession-proof firms. But there are a few warning signals to be aware of. While many businesses are for sale during a recession, this does not always imply that they are a suitable investment. If you want to make a wise investment, but don't know how to analyze a stock or even where to start, financial measurements are the way to go. Calculating these financial measures can tell you whether you're looking at a firm that is dependable and can be relied on to provide excellent returns year after year. First, be wary of companies that are in debt. When a recession comes, companies that are in debt are in peril, and bankruptcy is a serious possibility. It is critical to investigate the company's debt and how it relates to its earnings. When it comes to debt, free cash flow is a fantastic sign of a company's soundness. You may compute its free cash flow as follows. To begin, look for the company's operational cash on its cash flow statement. Subtract the purchase of property and equipment from the operational cash flow. The figure represents the company's free cash flow. Next, divide free cash flow by total long-term debt, found on the balance sheet, to calculate how long it will take the firm to pay off its debt. If a business cannot pay off its debt in a brief period of time, say 2 to 3 years, this is a poor indicator. In an ideal world, you would only invest in a business with no debt. But if it has enough free cash flow to pay off its long-term debt in a few years, it's a solid firm. Second, avoid management that wastes capital. A recession-proof firm must have a team of executives that believe in the company and will guide it through difficult times. How capital is allocated is one measure of excellent leadership. When it comes to buying back shares, you can see whether management is allocating cash appropriately. Are they repurchasing shares at the greatest possible price? Avoid doing business with these firms. This is a definite indicator that the firm's leadership is more concerned with protecting themselves than with defending the corporation as a whole. Third, if you can't determine a long-term value, don't invest. Any investment requires knowing the company's long-term worth, which can be difficult to establish during a recession. We will presume that every firm we examine will suffer some form of negative impact as a result of the recession. However, if it has a large moat, little debt, and prudent capital allocation, it should be able to survive. We only want to invest in firms that are recession-proof and satisfy these requirements. If a business fits these conditions, we may calculate its long-term worth as follows. First, we anticipate that the firm will have difficulties in the next years, but that it will stabilize with the economy in about 5 years. After 5 years, we may anticipate the firm to continue growing at a reasonable rate and assess its long-term worth accordingly. If you're unable to evaluate a company's long-term worth, you should be patient. Continue to conduct research, and monitor the stock market and how firms respond. Don't be in a hurry to invest. Instead, focus on learning everything you can about the companies on your watch list. If you want to understand more about investing during a recession and how to create a recession investment strategy that will help you succeed, you can watch more tips mentioned by Charlie Munger in this video.